Hey y'all, it's Jodi here, and you're listening to my flippin' podcast.
Y'all, you just gotta embrace the suck.
I'm in my 30s. I have 3 kids,
All born in different decades.
selling houses, flipping houses, renting houses, raising kids, random farm animals.
I can't deal.
Hey y'all, welcome to the latest episode of My Flippin' Podcast. I'm your host, Jodi Terrell, and today I'm really excited because I have one of my longtime friends and colleagues, Mr. Thomas Moore with First Bank Mortgage. Thomas has been in the industry for a very long time.
Long time.
How long now?
Started doing solely origination in 2004.
2004. So I wanted to have Thomas on because not only is he an expert when it comes to, mortgages and lending, but Thomas has been in the business long enough to give some perspective on this wave, this roller coaster
Right.
that we're on, because he rode out the crash last time, survived, came out a little bloody, like all of us, but you survived, and
Yep.
you've had a very great thriving business since then. And anytime I have questions about things, I call Thomas, because usually he knows all the little obscure laws, and I'll have questions about anti-flipping rules or whatever, and I highly recommend, if you're going to be buying a house, the first step that I always tell everybody is get pre-approved. That is the most important thing that you can do, especially in today's market where it's so competitive. We were talking just right before we started. Thomas said, "Hey, I've got to stop a second. I've got to send a pre-qualification letter, because houses in this area are selling so fast, particularly in North Alabama, which I know you do a ton of business in the Huntsville, Madison area. And these houses are going on the market, and in less than 24 hours, we're seeing 10, 15, 20 offers over list price. And if you don't have a pre-approval letter, shoot, you're getting chunked.
Yeah, you're in the first round of cuts with no pre-approval letter.
So it is very important to get a pre-approval letter. And then the other reason why I wanted to have Thomas on is because I know a ton of you guys listen to this podcast, you watch our videos because you're interested in real estate investing, and it's important to have a mortgage broker that you can depend on, that you can call on. So I highly recommend that you find somebody and that you start a relationship, because it is tough. I mean, especially if you're flipping houses, I mean, your end goal is to sell it. Well, you need to have some knowledge about what that process looks like. I know not everyone out there is a real estate broker like I am. And so you've really got to, educate yourself on, how do you make this house financeable, what's going to get you on appraisal, how that whole process works. So I'm really excited to have you on today.
One of the big things we've always seen is, what do you actually have to fix?
Yes.
I mean, everything in the house doesn't have to be taken out on a flip, and you don't have to take everything out and throw it away. You can repaint, you can reuse, you can keep a lot of the stuff, but a lot of people think because it's a flip, you have to actually throw everything out and just start from scratch.
Start
and
over.
And you're the same way. You always call me, what about these steps?
Yeah. I mean,
what about this handrail?
That is one thing,
Yeah.
because a lot of times, if your end buyer, a lot of times is going to, in the residential world, they're going to end up with probably doing some sort of government insured loan.
Right.
So let's talk about that really fast. Like, what are so we have conventional loans,
Right.
which are not government insured,
right.
or
so conventional loans are backed by Fannie Mae and Freddie Mac.
Okay.
So they control, Fannie Mae and Freddie Mac control their own guidelines. They tell us what they want to see. They tell us what they're looking for in the houses, right? What condition does the house have to be in? But then the opposite side of that is, all the other loans are government backed. You got VA, you got FHA, and you got USDA. So you're looking, the government comes in and says, "Ooh, we want a little more restriction on, we're looking more at health and safety hazards. We got a few more restrictions than the conventional guys." But so much of the market, is especially when you're dealing in this area, you're doing a lot of government. There's a lot of VAs, a lot of FHAs, a lot of USDA, a ton of USDA. You get into the rural Alabama, that is, Marshall County, Jackson, DeKalb, Madison, or Etowah County. there's a lot of USDA eligible areas, and a lot of people do that because it's 100% financing. So they do a lot of that, but at the same time, there are rules that apply that are health and safety rules.
Right.
And if you're not ready for them, you flip a house and you're like, man, we did a great job, we're ready to go. And then we show up with an appraiser and say, oh, by the way, now you need to, replace this broken window, scrape and paint this, and by the way, now you got to put handrails all the way up these stairs and all this. And people are going, oh my gosh, I've just spent a month and a half getting this thing ready, and now I've got another week's worth of work on it. Holy smokes, I should have known this earlier.
Yeah.
So,
and it causes a lot of stress too when you're in that, because a lot of times, the appraisal happens, 2 or 3 weeks before closing. A lot of people at this point have, moved on to another project, and then all of a sudden you get jerked back. And it delays things, and it kind of can just create an issue with your momentum.
Well, getting a plumber to come out and put a pop-off valve through the floor after he's been out there before and he's done all of his stuff, and it's hard to do. It's hard to get the guy to slow down and go, oh, by the way, I need you to go fix that one problem.
Yeah, exactly. So it is important to really kind of know what market you're in and who your end buyer is going to be. And so I want to talk about USDA for a second, because that is something that's very common in Etowah County. So the USDA, or you'll also hear it called a rural development loan. And so basically it's going to be properties that are in an area that the government has deemed rural. And some places you would think would be rural are not, and some places that you don't think would be rural are. So the best bet is to go and look at the map, which is on, is it USDA.gov? I think.
USDA eligibility map online. It's pretty easy to find. Google it.
Pretty easy to find. And what that's going to do is it's going to allow for a buyer to have 100% financing, and then the seller can pay some of the closing costs. And so it's a great way. It's a great loan product for, especially if you're targeting like a first time home buyer or something like that. So one of the other things that comes up on USDA, and I'm not sure if this is specific to USDA or if this may be lender specific, is the septic inspections.
It's actually a mix of both. It's actually the appraiser has to indicate one way or the other.
Okay.
They have to say, hey, everything looks to be in working order. Don't see any signs of problems. Looks like it meets the HUD guidelines. We're happy with it. Or they put a tag in it that says, hey, we're not sure about that septic tank. You need to get somebody out there to check it.
Right.
So now a lender can overlay that and say, hey, if it's USDA, we don't care. We want a septic inspection. That is completely their prerogative. They can do that. Most of them don't. I've not seen many that do put that overlay, but they can. So yeah, it's not uncommon.
And I've been burned by that.
Oh yeah, it's always a good find.
So if you have a property that has a septic tank, I recommend having a septic inspection. I don't care if you're buying the house to flip, if you're buying the house to hold, if you're buying the house to live in. Have a septic inspection.
Yeah,
it's cheap, relatively speaking.
Yeah, you're not talking a ton of money, but you are talking a ton of headaches if it is a problem.
Because Alabama's a buyer beware state, so that means that the seller is only required to disclose known health or safety issues. And so if a seller has not lived in the property, if it is a flip or if it's a foreclosure or even just, hey, I inherited this property, they really have no obligation to tell you anything.
Well, yeah, and they may not know. That's the thing. A lot of times people confuse the fact of they're responsible to tell me with the fact that they may just not know.
Exactly.
Like you said, if it's an inherited property, hey, I've never lived here. I don't know if Grandma had problems or not.
Right.
So it's tough.
and that's definitely one of those things that can come back and bite you big time on the back end. So so septic inspections that's kind of one of my pet peeves. So we talked a little bit about USDA. Then FHA, from a flipping standpoint, is something that I consider because FHA has anti-flipping rules. Yeah. Let's go into that a little bit.
Yeah. They put day restrictions on it. Like you can't buy a property today for $50,000 and turn around and sell it tomorrow for $51,000. Once you buy it under FHA guidelines, you're sitting on it for 90 days before you can sell it for a penny more than what you paid for it. There is that restriction in there. They're saying, hey, we want you to at least be doing something to it. We want to make sure that it's not some sort of, it cuts down on your scam stuff. Where used to back in the crazy days, you'd have people doing all these crazy contracts where they never really owned the property. They had signed some sort of weird agreement that was drawn up, supposedly it was legal, but you really didn't know. And they were trying to churn these houses, and it would be, you'd show up to closing and there was two people selling the house. This guy sold it to this guy literally at the table, and then this guy sold it to my buyer. And it's like, wait a minute, that doesn't look right, because this guy only got $1,000 profit, and this guy just got a $30,000 profit. What in the world just went on here?
Right.
So that's the reason they stepped in and kind of put that all in place, was to put the stop on that.
Mm-hmm.
And so now you've got that 90-day flipping rule. If you buy it, congratulations, you got 90 days to get it fixed up and ready for the market.
Right.
Once it does hit the market, though, it's not automatic. Just because you pass 90 days, on the 91st day, you can do whatever you want to. There are restrictions about, they can come back and ask, hey, we want a second appraisal. Hey, how much did you spend on this thing?
Yeah, if there's a big
discrepancy, you can have those things stretched out to, 180 to 200 and some odd days. I mean, it can really get long.
Yeah, so kind of to go into detail a little bit more about that, and I'm glad you brought it up, because that's a great point that I've failed to mention on any podcast I've ever done. So let's say, for instance, you buy a property for $50,000 and you turn around and 90 days later, 120 days later, you sell it for $200,000. Okay, that's $150,000 spread. Well, let's say you spent $130,000 on the renovation. I mean, nobody knows if you made a $20,000 profit or a $100,000 profit. Yeah. So what you have to do to help the process along, and I just believe in kind of getting ahead of problems,
right,
that these are going to be speed bumps or roadblocks, is to go ahead and have a list of everything that you did. I mean, it doesn't have to be detailed room by room, but if you replace the kitchen cabinets, put a new central heat and air unit, put a new roof on it, did all new windows. Right. I mean, those big ticket items, you need to have that itemized out and ready to go to the appraiser.
Yeah, that appraiser, when he shows up, that's generally, if it's a flip, they know it. I mean, these guys aren't dummies. They know what they're doing. So they generally have done enough research. They go, oh, hey, look, they've only owned this for 95 days or 105 days or whatever. They bought it in an auction. They bought it on an auction or short sale, whatever, and now they're going to sell it. So they generally have that information already in their pocket.
Right.
So when they show up, they're expecting, give me something to hook on to that I can say, hey, you did this. Because if you've not done anything, it's not always a slam dunk that the appraiser's going to go, yeah, you're good, take it on. You're going to get the value you want. Sometimes they go, hey, the market may not be supporting you if you haven't done some sort of upgrade. Right. So yeah, like you said, the booklet or a list or something kind of outlining what you've done, what you spent. It really does help them out. Everybody thinks it's like, oh, I'm giving away secrets. No, you're actually making your deal work if you can do that.
Yeah. So we talked a little bit about the FHA anti-flipping rules, and that is 90 days from the date that the deed is recorded to the date that it goes under contract.
Correct. You got to be 91 days.
91 days.
Yeah, 91. And I promise they'll send it back for a day. They won't send it back. They will decline your file for a day. Yeah, they will decline your file. You get to go write a brand new contract, start all over again for one day.
And the recording date on the deed is important.
Yes.
Because if you're closing with somebody who is not going every day to the courthouse, or if they're holding files, or if it's one of these traveling closers, then you may say, well, I bought this house on March 1st, but if they didn't make it to the courthouse until March 10th, that's your start date.
That's your start date then. So yeah, you got you can have some big discrepancies there if you're not careful.
Yeah, so it's definitely one thing that you need to be aware of. So then we were talking a minute ago about the, about just trying to keep up with everything that you're doing to help the appraisers out. And I think that's going to be even more important as we continue down this crazy road. I'm of the impression that the market that we're in, that this is not sustainable.
I don't think it can stay this way forever. I think you're going to see it stay this way longer than everybody thinks it will.
Okay.
Just solely because we've got so many people coming from out of town. You've got people coming to Alabama that, you know, the only thing they know about Alabama before they show up here is, you know, football and you know, that kind of stuff. And then all of a sudden it's like, oh, wow, we're here. This is really cool. It doesn't cost $600,000 to live in a 2,000 square foot house. Holy smokes, I can actually live here. I can actually buy property here. I can, you know, I don't have to have you know, all these rules and regulations on me. Wow, okay, my job's giving me the option to go to Alabama or go to Maryland or go to Florida or go to wherever with some of these places. They're figuring out Alabama's a pretty
pretty
good,
sweet little state. It really is.
And let's just be honest, coronavirus did us a huge service when it comes to that, because all of a sudden, all these people that were stuck out west and up north that were in these restricted states where you couldn't leave your house, where you couldn't get out and go do what you wanted to, all of a sudden it was, you know, you're allowed to be in your space, which you own your lot. Well, if you've got a lot that's the size of a shoebox, good luck.
Or you're in an apartment.
Yeah, one lady I had, she had been locked in her apartment for weeks. You know, she could get out and walk up and down the hallway. That was it. You know, that was as far outside as she got. But she comes here and she's like, oh my goodness, I have, you know, you would have thought she bought 1,000 acres and a 10,000 square foot house. You know, she bought a 1,500 square foot house on a half acre lot, and she was the happiest thing you've ever seen, because she's like, oh my gosh, I can go outside, I can do what I want, you know, I can get out, I can do, and it's not, you know, it's not that same.
Can we call it freedom?
Yeah, exactly. Yeah,
it's freedom, y'all. That's what it is.
Yeah, it's like, hey, I can, you know, I'm not restricted to four walls, which she was. I mean, and you can't, you know, she was where she was at. It was really bad. Don't get me wrong. So it was legit that she needed to stay inside. But, you know, man, think about it. Locked in four walls, thousands. I think she said her apartment out there was like 1,100 square feet.
Wow.
And she'd been in there she would stay inside for like 3 or 4 weeks at a time. You know, everything was delivered. So it's like,
that's no way to live.
Yeah, and that's where she got to with it. Her company offered her a transfer, and she's like, hey.
Well, and I think a lot of companies and a lot of employees are finding out that they can work remotely.
Oh yeah.
So there's no reason why you have to live in the city where your corporate headquarters are. You know, and I think we're going to see, a decline in kind of a tank in office space and these big commercial buildings. I have a really good friend of mine that works for a large real estate auction house, and they've not gone back.
Yeah, no.
I mean, they're still all working remotely.
Right. Well, think about this. I mean, if you're just for our local area, if you were going to be in some industries, you had to live in Atlanta if you were going to be at the top of your game. You know, a lot of these finance guys, you know, all these securities trading type stuff, the insurance guys, if you could be in Atlanta, you could be top of your game. You could get some big companies you could work for. You could have. Also, it came with a big price tag, right? I mean, let's go look at rent in Atlanta or right around Atlanta. I mean, you're talking at least, anywhere $2,000 to $3,000 a month easily.
Oh yeah.
That you're paying. You now can do that remotely from Gadsden, Alabama, and rents what, $900.
Yeah.
And that's a huge house. You know, renting for $900. I've got all the space I want. Oh, by the way, everything's not as expensive, and I don't have to sit in traffic either. Mm-hmm. Well, I mean, if I can put $2,000 back in my pocket,
drive over once a week or once a month or whatever you're going to do for some in-person meetings or around the golf.
Yeah, I mean, I can instead of having to get in, fight traffic, get to the office every day, I can go once a week, play golf with the people I need to play golf with, have a meeting while I'm there, come home. I've spent 2.5 hours on the road one way, done my day, 2.5 hours on the road back, or 2 hours on the road back. Okay, done. And I'm saving $2,000 a month just in my rent.
And Alabama, especially North Alabama, we're just I've always been perplexed at why we haven't had more growth, which I think we're definitely seeing that now. I think the mayor in Huntsville has done a fantastic job. Right. There's so much industry and big tech, high tech companies going there. But if you look at a map, we're centrally located between some of the largest metropolitan areas in the southeast. We've got Birmingham, from here is just 60 miles to the south. You can be in Atlanta in 2 hours, depending on traffic and what part of Atlanta, but still 2 hours is reasonable. And then you've got Chattanooga, which is another, that's a hot spot for investing and lots of growth.
Nashville has exploded.
And Nashville, oh my gosh.
Nashville has hit a level of crazy that expansion and growth, and it's just to the level of crazy up there. I mean, how much that place has changed. And it's like, now you're sitting there used to it. It was like, you had Memphis over here, you had Chattanooga over here. Nashville was in the middle, but unless you were a singer, we aren't too wild about it. We everybody needs Vanderbilt every once in a while, but there was really not. It just really hadn't taken off, kind of like you're saying. But now think about it: you got Memphis, boom, Nashville, Chattanooga, down to Atlanta, back across to Birmingham. I mean, we're caged in pretty well to for companies that these feeder, what they always refer to as feeder companies.
Right.
These feeder companies for those areas, those, research and development type stuff where they need a small labs and stuff like that. And they don't want to have it on their own site in their big offices. I mean, it's going to be huge.
Yeah. Well, I'm excited for the future of Alabama. I think it's going to be great. So, But kind of back to what we were talking about the sustainability of this market, because before we started recording, you and I were talking a little bit about, you were telling me about some clients that you have who have been beat out multiple times.
Yeah.
Where they're submitting offers, really what we would call a clean offer. Mm-hmm. There's not a lot of contingencies. They're pre-approved. They're solid. They're making offers, sometimes 10 and 20% above list.
Exactly.
And they're still losing out.
Yeah.
And this is what was back to Nashville. This is what was happening in Nashville a couple of years ago.
Yeah.
I have friends who are in real estate up there, and they were telling me those nightmare stories where I cannot imagine. It is so hard typically when you're buying a home to live in. It's an emotional decision.
Right.
It's everything's got to feel right, the location's got to be right, the size has got to be right. And so I feel for these agents, especially in the Huntsville area, in the Madison market, where it's hard enough to get somebody to make that commitment one time to pull the trigger on a house,
right.
But to have to do it over and over again.
Wow.
And
it's
continue
like fatigue
to have,
for those buyers. The buyers get they get so tired after the first two or three that happens, which when you're going into a situation where you're one of 10 offers, you're one of 10.
Yes, your odds are not great.
9 of you are going home unhappy. There's only one of you that's going to be happy. There's 10 of you, so that means 9 of you are going home mad. So, but with that happening, it's like, the first time it happens, everybody goes, okay, we'll get the next one. We're on number 4.
Right.
We're number 5, and the realtor's trying to hype them up, going, "We'll get the next one." And it's like, you said that 3 ago, 4 ago, whatever. It's like, oh man, let's keep, keeping people to where they don't just, and I hate to say give up, but they just get so frustrated that they're like, oh my gosh, I don't know what we're going to do.
Yeah.
I
think after you do that, certain people who maybe don't have to buy something, maybe they want to buy, maybe they want to get out of their apartment, but they're not in a have to situation. I think they exit the market a lot of times because they're like, hey, I'm tired of these bidding wars. I don't want to do this anymore. I think this is getting kind of crazy.
That's right.
So then so I think that's where we're eventually going to start seeing some market correction. And we're going to have to.
We've seen sellers back out of selling because they can't find anywhere to go.
Yeah.
They get tired. They figure out that, hey, we can't go where we want to go. We're not doing this at all. And we've had a few of those that have backed up and said, look, we're sorry, but we're just not selling. And it's like, then you got all kind of problems. But,
yeah, then everybody's mad.
Yeah, everybody gets mad. But it's but
you better write that into a contract, agents. If you think that's going to be an issue, if you're representing the seller, you better put that in. Because I've had that happen before, and the contract that we use locally, there is no clause that says that the seller's got to find a house or that the seller's got to get pre-approved. You can buy another house. So if you're concerned about any of that, you better write that into a deal, or you're going to have a lawsuit on your hands in this day and age.
And it's a very real problem right now.
Yeah.
For sure.
So I'd like to back up. I kind of teased in the opening that, you've been in this business for a long time. Yeah. Longer than your age, because you're not that old, right?
Thanks, Jodi.
So it's like, how have you been doing this for so long? But back when the market started to crash, so this would be 05.
Really? It started to hit here 07, 08.
07, 08.
07, 08, it absolutely dropped out from under Alabama. Alabama didn't have the boom of the Sand States, right? Everybody talks about, we had that big bubble. Alabama didn't really have the bubble a lot of places had, because your New Mexico's, Nevada, California, Arizona, Florida, those guys were seeing back in 04, 05, 06, 07, you were having places out there that you were getting like 30, 40, 50% appreciation in a year, 2 years, 3 years, and that's where a lot of those programs came in. It was like, the value's growing so fast, buy it this way, refinance next year, with the $50,000 you made while you were asleep. And it's like, that's not good for everybody, because that eventually came to a halt. And that's when the bubble burst and everybody said, dunk, we all hit bottom. But, Alabama had a little bit of that, but not nearly that level.
Right.
When you start talking, Alabama had some appreciation, it got a little out of control. To make it work, you got to be able to, people's income's got to grow. Just because you're running the price of the house up, but you're still got incomes that are way down here, you can't. You just can't run those house prices up that way. So that's kind of why Alabama didn't catch that first time through, is that the income wasn't growing nearly fast enough for us to get those kind of gains. But a lot of those Sand States, they did. Those guys were making a lot of money out in those areas, and and the values just took off on them. And that's where so many of them just absolutely things got out of control overnight. And then when it ended, it was like turning off a light switch. Everything was gone. Yeah.
Well, I think there was sort of like two parts of what happened in the crash last time, is that you did have this crazy appreciation that happened, like you said, out west, particularly, and I like you called it the Sand States, so California, Florida, Nevada, where you just saw this exponential growth that drove the housing prices up 20, 30, 40, 50%, like you said, in a year's time. And a lot of that was fueled by the lending practices that were going on, because it was very,
we can't do any of that anymore.
Yeah, we laugh and call it like the Wild Wild West.
Oh, it was,
or the, sometimes you hear people call it the good old days, depending on what side they were on.
I was going to say, it was depending on which side of it, you might be right.
And so here, I think probably in Alabama, we didn't have a population explosion. We didn't have like this big economic boom that drove the price up. So when the market crashed, I think what we felt, and we felt it a little bit later than everybody else, was because the mortgage industry stopped.
Right.
It just sort of stopped.
You literally had places. We had a place in Florida that we used to lend through sometimes. We did some brokering through them at one time, and I'll never forget the story. The guy, a friend of ours, worked for them, and they were in Florida, and they're in there working, doing their thing one morning, doing their regular routine. Mm-hmm. All of a sudden, fire alarm. Oh God, get out of the building! Get everybody out of the building! Building's on fire! Everybody takes off out of the building. The doors were locked behind them when they went to go back in. The building closed. The business closed that moment.
What?
Yeah, swear it was the craziest thing you've ever heard. But they pulled the fire alarm, got everybody out of the building, locked the doors, and that was it. Goodbye. You're done.
I hope you got your purse.
That was it. There was no, But I mean, stuff was. I mean, you remember when we had the implodometer? Did you remember the implodometer from online? Oh my gosh, there was an implodometer, and it was literally a website we all checked every morning. I mean, it literally stayed on your desktop, and it would show the companies as they exploded, and companies went out of business. Just boom, that fast in the mortgage business, because things just abruptly stopped for them. You know, they had these big warehouse lines. They had all this stuff going on, and then all of a sudden, the money was just gone.
Yeah.
You couldn't offload the loans you had. Your pipeline was full. There's nothing else to do.
People who aren't in the industry, I don't think they understand how interconnected and how woven everything is together. So it's like, you know, a lot of these smaller mortgage brokerages, they are depending on money from, like you said, from these bigger companies, from these warehouse lines. So then when the crash happened, and if I say anything stupid, you know, I'm not a financial expert.
You're good.
So this is going to be totally like layman's here. But so when the crash happened, a lot of that was due to the fact, and I sort of, even in my naive young state when all of this was going on, because I came into real estate right when, you know, where you had all these people who were getting stated income loans, and what was the other one where you have like a 500 credit score?
Lord, you had stated income, stated asset, no income, no asset. I mean, literally, you just, you know, are they breathing? Okay, give them along.
Subprime.
Yeah, subprime.
That's what I was going to say. The subprime market.
Yeah, subprime was a disaster waiting to happen. So I mean, it was absolutely crazy.
And there was also too, there were a lot of people who were offering products that were that had balloons.
Oh yeah.
So you know, you got a 3-year balloon or a 5-year, and that just means that in 3 years you either got to pay it off or you got to refinance. And so a lot of people, I felt like, you always think, oh well, in 3 years we won't have daycare payments anymore, and my car will be paid for, and I'll have that promotion at work. But you know, life happens.
Right.
People never think about the bad stuff in the future. They always think about the good things. And so, you know, I think that was a big deal too, is that you had a lot of these people who had notes that were coming due. They couldn't refinance. And
lost a job. You know, value on the house went down. I mean, I'm a prime candidate. You know, we bought our house and turned around 2 years later, and you know, I'm like, oh, what about that? I had one of our appraisers look at it. He goes, oh, okay, you've lost $40,000, and I'm like, eek, you know, and fall over now. You know, you know, we bought 2 years ago, and he's like, yeah, but the market's down. Nobody, you know, there's this many foreclosures around you. You know, you can go buy the same house for, you know, $50,000 less than what you bought it for. It's like, oh, that's great, thanks, appreciate it. I think I'll stay right here.
Yeah, and a lot of people have to make those decisions, and you know, I think, and I don't want to come on here as like a big doomsdayer or warning, but I do think that you have to open your eyes to kind of what's going on, and to sort of see that this is not normal. Right. This isn't just healthy, steady growth that we're experiencing. Right. You know, you're under the belief that rates are going to go up, that we're going to see rates going up. Yeah. So I would say right now, if you're on the fence about buying something, you probably should do
Pull
it.
the trigger now.
But a
month could literally cost you.
But that also doesn't mean don't get crazy and overpay.
Right. That's the key to me. The key to me at this point is people start looking at, hey, you know, where I'm at, can I sell it and make money? Great, fine. You're going to make money if you sell it. I mean, there's very few people right now selling not making money. The problem is, where am I going? Okay, if I have to go and I have to pay, like we were talking about before, $30,000 more than market value, or than what I really want to pay for it, what it's really worth, if I have to overpay for it, well, if the market cools off and the prices drop, well, I was 30,000 out of bounds to start with.
Right. Much
less now, and it drops another 20. Oh wow, I'm 50,000. You know, the house is worth. You know, I bought it for 250. Now it's worth $2. You know, and it's like, here's a problem. You know, and I think that's a lot of what people that have been around and lived through the last bubble of it. I think that's what a lot of us are kind of seeing, and it keeps coming to my mind. I know every day I think, oh my goodness, but that's kind of what we're seeing is, it's like, man, I just hope these people that are coming in and are paying these prices understand that just because you paid $250,000 for your house does not mean it's worth $250,000 tomorrow or next year or the next year or 5 years. You may wake up like a good-looking mortgage broker that I know and wake up one morning and find out that you're $40,000 less than what you paid for it.
Right.
And you just go, wow, okay, what do we do now?
Yeah.
You sat there. We've been in our house 14 years, by the way.
Yeah. Well, halfway
Yeah.
30,
Halfway
right?
to 30.
If they're halfway through 30, that's what
Halfway
you
to
did.
30, yeah.
Are you wishing you'd done a 15 now?
No, I'm wishing I'd paid $40,000 less. That would have took a couple of years off of it by itself.
Yes, that's true.
But yeah, but really, that's it. I told somebody, a realtor the other week, I said, it's kind of comforting to look at it and see all the people that were like me, the ones that I know that were in the business, the realtors that I know that were in the business, the other mortgage bankers that were in the business at the time, and you see them all doing the same things right now. Everybody's being conservative, everybody's being careful. You don't see people swapping houses. You don't see them, you don't see them going and just buying, overpaying and things like that. If they are buying, it's like, ooh, just, be careful, and I think a lot of that is from the crash, that first go round with the crash. I think a lot of us learned a lesson that's like, ooh, don't want to
and
do
a
that
lot
again.
of us learned a very expensive lesson, a very painful lesson.
Oh, yeah.
And,
yeah.
You tend to not forget those.
Oh, for sure, yeah.
And so when you see it coming again, you're like, oh, let's pump the brakes.
Yeah, it's like, hey, pump the brakes. It's just...
Kind of, and I'm
slow
not
down.
Saying that everybody needs to freak out. I'm not saying that at all. I'm just saying just be mindful of what's going on. And I was talking to some investors last week, I believe it was, and I just said, right, my best advice right now is don't get caught in a big long project.
Right. Yeah.
Where something that could take, where you might be working on it for 6 months, 7 months, 8 months, because that's, if the market turns and it turns fast, you don't want to get stuck in there.
Right.
You want to be in a place to where, if you're flipping houses which we are, we're flipping a lot of houses because the market's up.
Oh yeah.
We're going to ride it as long as we can,
It's your time, that's right.
And then when the market goes down, we'll buy houses and hold them.
Right.
That's the plan. But right now, we're flipping a lot of houses, but we're making sure that we've got really great, trying to get really good deals.
Right.
And in these houses that we can kind of get in and out of, where we're 90 days or so. Just to kind of, it's just to protect yourself.
Right. And that's the thing, right now Alabama's got a housing shortage. Everywhere does, but Alabama's got a massive housing shortage. Anywhere you look, houses on the market. You're at half of what you had last year, maybe less. You look at some of these areas, Birmingham, Huntsville, some of those areas, and it's like, oh, how many days of inventory do they have? It's like, oh, that's not even a month.
Yeah.
Just for average number of sales, and it's like, holy smokes, what are we going to do? So you got builders jumping in. You got builders coming in saying, hey, we're in. We will start these developments. We'll build these neighborhoods. We'll do all these things. That's a long-term investment, so those guys are even right now being a little cautious, because they don't want to get hung in in a 200-unit development and be like, hey, we've paid for the roads, we've paid for all the utility services to be in, we've paid for everything, we've laid out all the money, and now the housing market cools off. And so even those guys are being a little bit cautious now. They're kind of going, ooh, let's finish out some of the projects we got before we really break ground on that newest development,
Right.
And some of them have a different opinion, and some of them, especially in Madison County, there's people over there, they're like, hey, give me any kind of dirt, we're going to build a subdivision and we're going to go with it, because they feel like they're going to be strong that long, and I think they will be.
Yeah.
But there's a lot of areas that are not, that I don't know if you're going to have that, I don't know if the speed of growth is fast enough for all your areas to be that way. But so, a lot of those builders are kind of being careful now too.
Yeah. Do you have any advice for people out there that are maybe thinking about investing, buying, refinancing?
Mm-hmm.
What are your thoughts on that?
As far as the refinancing stuff goes, get it done. Do it now. Don't wait. Don't hold off. Don't wait till Oh, rates are going to go back down. No, they're really not. You better do it if you're going to do it, because if history's shown nothing, it's going to, things flow, things up and down, up and down. Your down that you're looking for might be 3 years down the road. You don't know. So, as far as the refinance stuff, get it now if you want it. As far as the investors go, get the best deal you can on your financing if you're going to have to hold it long term. If you're buying something and you're like, hey, I'm buying a rental house, I'm buying a duplex, I'm buying an apartment complex, I'm buying whatever, I'm buying commercial space, get the best deal you can and get that thing locked in long term. Don't do
a 3 or a 5.
No,
That's dangerous.
Don't get into any of the, don't get it, a lot of people are like, oh, you can do this and you can do that and you can play with these arms and you can play with these balloon payments and da da. No, right now is the wrong time for that. If rates were high, you might pull that off. But right now is the time to, hey, get the best you've ever gotten on commercial financing or residential financing or whatever. Get it in now, and that way 2, 3, 4, 5, 10 years down the road, guess what? I locked my stuff in back when it was 3.25.
Right.
What's rates right now? Oh, 7.5. Oh,
yeah.
Okay. I'll sit with my 3.25, or whatever, and that, because that's the thing. People have short-term memory, everybody looks back and we only remember a year. But I'll be honest, when I started doing this, rates were at, 6.5.
That's where I remember it.
5 to 6 to 6.5. I mean, we were at one time, I remember we were doing some 80-20 stuff. Oops, sorry about that. I'm not supposed to be saying that.
We can bleep it.
Bleep the name. But we were doing some 80-20 stuff where it was an 80% first at 7.5 or 8, and the second was a 10% second at 12.5 or 11. So you had a 7.5 first and 11 or 12 second to give a total of 100%. It was. You had 90 10s and 80 20s and all this stuff. Needless to say, we don't do that anymore. But I mean, people forget that was good rates. People are still buying houses. I can show you. I've got my numbers from all the years I've been doing this. Every loan I've ever closed.
And that wasn't that long ago.
No,
because we're not that old.
No.
We're not. And I remember
we
this.
neither one draw Social Security. I promise.
No.
not gotten that lucky yet.
Not yet. So, and I think that's a great point. And I remember, my mom has told the story a bunch of times about, and I was alive then, so this would have probably been in the 80s, I would say, that she was thrilled to find a VA assumable, and it was like at 14%.
Yeah. Oh, but best story I've ever heard. A friend of mine's dad, he was, they were trying to get back to my hometown, Gunnersville, and he had just graduated school. He was working in somewhere down below Birmingham, wife, one kid, one on the way, whatever the story was, and they were trying to get back. Rates were like 12, 13%. He couldn't find a house. He couldn't get a loan, he was just out of college. He's like, oh my gosh, what am I going to do? Can't find a place to rent in town. He said that he got a phone call from the local banker who he had gone to school with. He knew the guy. And the guy called him and said, I know you're trying to get back to Gunnersville. If you can show up on Friday, bring me this much money, you can buy this house at this address, and the interest rate was like 11.5%, 12%. And he's like, but we'll get you this house at this address. Like, he had never seen the house before. He drove from the other side of Birmingham to Gunnersville, paid the money, signed on the house, didn't know what he bought. Like, literally had never laid eyes on it.
But he just had to have a roof so bad. I mean,
but he knew that the rate was so much. It was 2% lower than what everybody else was getting.
Wow.
So he could afford more house. He was like, I couldn't afford the house I bought. Yeah. He's like they basically gave him the loan based on the fact that they knew he was, his what he was getting into and what he was bringing with him. But it was just they knew him and they took a chance on him, and he's like, they gave me 2% less than everybody else that was getting loans because a guy fell out on that specific house and they were ready to close it that Friday, and they just pulled his plug and plugged me in and said, you're now the owner of this house. He's like, we didn't know what we bought. We just were like, we knew the general area because we were from there, but he's like, we didn't know. We just truly didn't know. So it's kind of crazy, but I mean that's the kind of stuff people don't realize is it's not that long ago. I mean, you know that was going on. That was, you know, you're talking
in our lifetime.
Yeah, exactly. Yeah, but you know it was, you know, my buddy, his dad. I mean, my buddy's same age as me, and he was probably 3 or 4 at the time.
Yeah.
So you know.
Yeah, and I
hate to say 40 years ago, but good God, that was a long time. Wow.
Don't say that.
Not good.
We'll bleep that too.
Bleep that too. Yeah.
So,
that.
so anyway, so I heard on a podcast the other day, people were talking about negative interest rates. You don't think that's
I don't think that's a threat right now.
Yeah.
Yeah.
I don't even really understand that concept. It was just like I was mind blown listening to this. And they were making it out like it was trying to spin it like into this, it was some great thing that was happening in Canada, and I'm like,
I think you just nailed it. They're trying to make it into. They're trying to spin it.
Yeah.
You know, and it's just like anything else you try to sell. I mean, whether it's, you know, back in the Amway days, you know, Amway is great. You know, I mean, you know, some sort of, you know, anything you're trying to sell, they're always trying to spin it and make it look good. You know, you don't ever go out and go, hey, this is a real junky house. You ought to buy it. You know, I mean, that's not what you do. You know, you paint it, you fix it up, you try to make it look as good as possible. But I think that's the negative interest rate thing. I think that's what a lot of people are trying to do with it is get it into a conversation and try to get some sort of traction and make it look attractive to people. But I don't know, I'll be honest, I don't know how in the world that's going to work. I mean, I just don't.
I don't know either. I mean, I just feel like we're definitely going to have some, we're going to have inflation, period. We're already experiencing inflation. And, you know, that was sort of the take that I was getting off of it, that this was like a you know, something that happens because of inflation, but I don't think that we've ever had negative interest rates in the United States, and I just think that would be devastating to the financial markets.
I think it's going to be different than what everybody thinks it is. I think everybody thinks you hear, oh, it's going to be negative interest rates, and you're thinking, oh, hey, I'm going to go buy a house, and the rate's going to be a negative 0.5%. You know. And that's not at all what they're talking about. They're talking about a lot of what my understand, and I'm not a financial advisor, don't play one on TV. So I'm telling you what I hear and what I understand. But my understanding is that they, you know, it's going to be what the banks are trading funds at.
Right.
You know, the banks are borrowing funds at negative da-da-da-da. That's the same way it is now with interest rates, because people will, my favorite thing in the world is for the Federal Reserve to raise or lower rates, and people call us and they're like, hey, I heard rates went up a quarter, you know, or went down a quarter. I want my interest rate to go down a quarter. I want my interest rate to go, you know, I want this better interest rate. And it's like, that's not how that works at all. You know, that's what the banks are borrowing money at. And yes, it does trickle down, but their big quarter change might do nothing for mortgage rates other than, you know, maybe you get 0.8% out of it, you know, something like that. You know, the market drive. People don't understand that part. The market is driven by people.
Right.
People drive it. People drive it. The way these mortgages are bundled and secured and sold on the secondary market is what drives that. If there's nobody willing to buy a bundle of loans at 3.25, nobody's going to do loans at 3.25 because there's nobody that's buying them. And I promise you, big banks are not going to be like, put that $2 million on the back burner, we're not going to worry about it. Or put that $10 million on the back burner, we're not going to worry about it. They know what's going to sell and what's not. You know,
right.
There was 10-year Treasury sale auction is today, right? Wrong? Something like that. The day we're meeting. How about that? This is not going to air today. But there's a 10-year Treasury auction today. And that's going to have a big I mean, it's a big indicator of, hey, is there an appetite for these things anymore? Or
I don't even know what that is.
It's where the loans we have bundled up and sold. It's where they're auctioning them off, and people buy them at auction. So
they only do it every 10 years?
No. The notes is called a 10-year Treasury auction. It's just the note they're buying is 10 years. So they're different ones, 10, 20, 30s.
I gotcha.
But the 10-year Treasury auction is today. And if there's nobody buying those, then that's going to be a major league problem, you know. So we feel like there's going to be good appetite for them. We don't think it's going to be a big deal. But if for some reason they just, you know, they went to auction today and it brought way less than what everybody thought, you know, that's gonna send a sign. Hey, everybody's concerned. Nobody wants that. Nobody wants those notes.
Yeah.
So it could be a big change.
Oh, Thomas.
Ain't it fun?
It's a lot to unpack.
Oh,
a lot of information.
Yeah. We got baggage like Delta. I mean, we can unpack all day.
Y'all may need to back up and listen to this thing twice.
Yeah.
And then, of course, if you want to get pre-approved or if you have any very specific questions, you can contact Thomas Moore, and we're going to link to all of his information. We'll do your phone number, email, website, all of that. And I guess that's going to be it for today. I don't know if my brain can handle much more. This is a lot. That's a lot of math for early in the morning.
Yeah, I was gonna say, it's too early for all that.
It is, but I think no matter what, I just want to say I'm going to proceed cautiously optimistic.
I think that would be the answer. Is listen to the whole podcast, listen to it 2 or 3 times. But I think the overall is, I think it's going to be good. I think it's just you better be careful, because if something changes and it's like, ooh, you definitely don't want to be out too far.
Yeah. Yeah, that's the thing. It's just making sure that you've positioned yourself to where you're not going to get stuck if something happens. Because if the market does go down, everything cycles. You can kind of see that it's going to, and it's usually 10 years or so is what it looks like if you were to spread it out on a timeline. And we're definitely due for a correction.
They were forecasting this correction in 2020. Just to be honest. I mean, we were going to stuff in 2018 and 2019, and everybody was saying, look out 2020, 2021. I mean, it was 2020 is going to be the start of it. 2021 should be the end of it.
Yeah.
COVID hit, and I think that changed things quite a bit. So I think the tenure is going to be stretched out a little longer. But like you said, I think it's just...
We're running to the end of that.
We are.
Yeah. And it's so funny because one other example before we get out of here, I have a friend of mine who will remain nameless, who was buying a house in a larger market, and they had sent me the information on the property, and it was like a Zillow link, and they were really excited. I was like, oh, I'm so excited. And I, of course, I just pulled up and I looked at the price history, and it was very telling. It's kind of scared me for them just a little bit, because you could see in the boom, in the early 2000s, the price was like creeping up around 300, and then it looked like 06, 07, they had put it on the market for about what they paid for it, and it didn't sell, and then it went on the market again for like 50,000 less, and then it went on the market again it had a price reduction of 20,000, and then it foreclosed.
Yeah.
And it sold, and at the bottom of the market, it sold for 110.
Yeah. And
then now my friend has bought it at 330.
Yeah.
Which is back at the top.
Yeah.
And I'm like, oh gosh.
Yeah. I think it's been a long, long time since you've seen a listing history like that.
Yeah.
And unfortunately, I think you'll see them again before too much longer. That you'll see some that start to come through like that. It's like, oh, this thing, ran all the way up here, and then now it's had to foreclose, and we'll put it back on the market.
Yeah. Well, thank you so much for coming on.
I've
enjoyed it. And if you guys have any questions, feel free to reach out to Mr. Moore. Again, we're going to link all of his information in the show notes. And if you have any questions that's specifically related to real estate, whether you need to buy or sell, or if you want to get into investing, you can reach out to me or one of my team members. You can find us online, jngrealestate.com. And be sure to follow us on social media. We're on Facebook at Our Flipping Life, on Instagram, our.flipping.life. And of course, please like and subscribe this podcast wherever you may be listening. And our YouTube channel, don't forget about that. So many ways to get information. We post something every week, and we really do appreciate you guys tuning in. So that's it for today. We'll see you guys next week. Bye, y'all.